Joining me once again is Jim Rickards, best-selling author of Currency Wars and the author of the upcoming novel due out in April, The Death of Money. Jim, thanks for being with us again.
Thank you, Danielle. Nice to be with you.
And what a setting. We're in New York City this time. We're at the Museum of American Finance. They'll also be hosting an exhibit from September 25th to October 1st called The Fed at 100. And that's exactly what I'd like to talk to you about today. But how are you doing?
Doing great. I don't know if the viewers know, but this museum is on Wall Street. We're just a couple blocks from New York Stock Exchange and the former U.S. Treasury building. A lot of great history right around here.
Right. Well, Kitco News came down for Platinum Week, and we'll be getting your thoughts on the precious metals in a bit. But first, let's talk the Fed, Jim. Someone that told me an interesting quote this week, and it was, "Don't play cards with a man named Ben." Do you think Ben Bernanke fooled the market?
I actually think the markets fooled themselves. If you listened to what Bernanke said and took him at his word, you knew that they were not going to taper. That's something I said beginning last summer and said it all the way along. But here's why. In May, when Chairman Bernanke first started talking about it, he said, we're going to reduce asset purchases, in other words, tapering, before the end of the year, if the economy behaves in accordance with our forecast. So everyone focused on the first half of the statement, the tapering, but they ignored the second half, which was it was conditioned on the economy performing in accordance with their forecast. Now, the one thing you have to know, the Fed has the worst forecasting record in economics. Every year, they give a one-year forward forecast. So in 2009, they forecast 2010, 2010, they forecast 2011, et cetera. For the last 4 years, they've been wrong 4 years in a row. They've been wrong by a lot, orders of magnitude. They say 3%, the economy comes in around 1.5%. This isn't just wrong; it's kind of wrong in the extreme. So my first thought was when I heard that, I said, "Well, the Fed's predicting the economy will grow. They're always wrong, so it'll probably hit a rough patch, so they won't taper." But then throughout the summer, in numerous speeches, Fed regional Reserve Bank presidents, members of the Board of Governors, Bernanke himself repeatedly said, "We will taper if the data is good." It was always data contingent. The data was awful. The August employment report was awful. Consumer confidence collapsed. Mortgage applications collapsed. So all I did, I just took the Fed at their word. The data was awful. So I said they're not going to taper. So I would say the Fed didn't fool the markets. The markets fooled themselves by a lot of wishful thinking.
Okay, so Jim, I know you were one of the few that kept saying that there wasn't going to be any tapering. Many people thought there would be. I guess my question to you is, can they even taper, or has this become some type of normal where we're just used to all this liquidity?
Well, I'm sure they would like to taper, but the question is, can they? That's exactly the right question. And it was interesting. No sooner was were the markets surprised that the Fed didn't taper than people started speculating. Well, they didn't taper in September, so they're going to have to taper in October, or they're going to have to taper in December. That's nonsense. I mean, again, the Fed said it depends on the data. Let's see what the data is. Let's see what the September employment report looks like. Let's see what the November employment report looks like. Let's get the information and then form a judgment. Sitting around now saying that they're going to taper because they didn't in September, right. That's not really clear analytical thinking. That's just, I don't know what that is. It's very weak thinking, actually. Now, if you're asking me if they want to taper, I would say the answer is yes. Can they taper? No, they'll be tapering into weakness. We might even have a recession next year.
But Jim, would things change depending on who comes in as the next Fed head?
No, because they all think alike. All these people, they went to one of four schools. They all went to MIT or Harvard or Chicago or Stanford. They were each other's teachers, each other's professors and thesis advisors. They all worked hang out in the same faculty lounge. They all think alike. So, yeah, it's significant. But Janet Yellen, if anything, is more of a dove than Bernanke. Janet Yellen gave a speech in 2012. She said there is no example in history of inflation breaking out when you have this much slack in industrial capacity and the labor market. Saying she looks at industrial capacity utilization in labor markets in the U.S. and said there is no chance of inflation. So she's absolutely fearless. She'll just keep printing money. So she'll be the last one to cut back. By the way, she's wrong. Historically, there are examples. Weimar Republic, Germany in 1921. They had a lot of excess capacity and a lot of excess labor, and the hyperinflation broke out anyway. So she doesn't really understand the dynamics of inflation. But my opinion doesn't matter. She thinks she's right, and she's going to behave accordingly.
Let's talk gold now. Obviously, the metal reacting to the news of no taper. Some analysts I had spoken to said had there been a taper of over $20 billion that they could have seen gold go back down to $1,000. Obviously not the case. So gold prevailed, basically. But do you think the momentum is real, or is gold ahead of itself here?
I think it's sort of temporary. Gold's a little bit ahead of itself, and here's why. Because you're right, the market had priced in some tapering, but not full tapering. So if the Fed had really tapered, gold would have traded down a little bit more, and I think that's right. The fact that the market didn't that the Fed didn't taper meant the market had to reprice. So gold went up, stocks went up, interest rates came down, bonds went up, et cetera. So we understand all that. But now, no sooner is that over than people are saying, well, they're going to taper in October. So this is putting pressure on gold again, downward pressure on gold, because there's more taper talk. Now, I think it's nonsense. Let's see what the data says. Look, if the September employment report is really strong, and we create, 250,000, 300,000 jobs, and the unemployment rate drops to 6.8%, and labor force participation levels off a little bit, then maybe they will taper in October. Okay. But on the other hand, I don't know if that's true. We could get a very weak report, and then tapering's off the table, and gold would rally again. So I think you just have to watch the data. But right now, I don't think gold is on a path where it's just going to go back up to the old highs on its own. There are catalysts that would take it there. One of them would be inflation. If we see inflation break out to the upside, that's definitely a catalyst. The other one, of course, is continued Chinese buying. Chinese are very smart, very secretive. They buy the dips. By the way, that's what I recommend to investors. Gold's volatile. There's no way around it. So make the volatility work for you. Every time it goes down a lot, buy some more. Just keep buying low and hold on to it.
And by a lot, do you mean a $50 dip, a $20 dip?
Yeah, certainly anything below 1,300, that's a great buy. Even the low 1,300s is a great buying opportunity. There is a floor. The Chinese put in a floor. The only thing that would take gold below the floor would be if really deflation gets the upper hand. I've always understood the economy, I have for a long time, as a battle between deflation and inflation. If deflation gets the upper hand and you see nominal GDP actually start to decline, that could take gold down. But remember, everything else will go down with it. I might like my gold better because even if it goes down, it could outperform stocks and other assets.
So Jim, let me ask you this. Does the Fed care to maintain gold high or low, or are they indifferent?
They're not indifferent. Here's the thing. The Fed knows that gold has to go higher. The Fed wants inflation. They have to get inflation because we can't pay off the debt without it. So the Fed's trying to engineer inflation, but they're trying to do it by stealth, 2%, 3%, almost like people won't notice. My view is when they get to 3%, the risk is that it'll shoot up to 6 or 7%. It'll get out of control. So the Fed knows that gold is going higher, but they want it to go there in an orderly way. What the Fed really cares about more than high or low is when it's disorderly. And this is what happened in the summer of 2011. You look at the data. The dollar was collapsing. The dollar reached an all-time low in July of 2011, and gold reached an all-time high. Dollar and gold are just inverse to each other. The Fed didn't like that because it was disorderly. It looked like it could just spin out of control. So they sort of, that's when they came in and squashed it down. They did that again in April. So I would say the Fed knows that gold is going higher, but they want it to go there in slow, steady stages, and that produces some of the volatility.
And Jim, before I let you go, you are the best-selling author of Currency Wars, and you have a new novel coming out in April, The Death of Money. Tell us a little bit about it.
The title is The Death of Money and the Coming Collapse of the International Monetary System. I wish I were a novelist, but it's actually a nonfiction economics book. It'll sort of pick up where Currency Wars left off, but it's a little more forward-leaning. Currency Wars had a lot of history, and I enjoyed writing that, and a lot of readers enjoyed that part of the book. The new book will have a little bit less history, but a lot more forward-looking analysis, looking at the future of gold, the future of the IMF, the future of the International Monetary System. I do expect a collapse, and the book talks about the forces leading to a collapse, when it'll happen, how it'll happen, and what comes next.
Fantastic, Jim. We look forward to having you on the program again.
Thank you.
And I invite everyone to come out to the Museum of American Finance. They have a exhibit on the Fed at 100 occurring from September 25th to October 1st. It's a great exhibit that they'll put on. And thanks for watching this edition of Kitco News with Jim Rickards. You can email us at newsfeedback@kitco.com or follow me on Twitter at Daniela Camboni. Thanks for watching.